Good afternoon. This is Larry Tentarelli with today's edition of your Daily 5 for StockCharts.com. So we'll get started with a brief introduction. My website is bluechipdaily.com. You can find me on Twitter. My call handle is @LMT978. Also, the website bluechipdaily.com. We have a 30-day free trial. So if you like the information that you hear today and you'd like to see some more of what we do, you can always join us for free on the website. So we'll get started with 5 key charts that are highest on my screen right now. We have a lot of volatility in the markets, obviously, and we're going to start with what I think is one of the most important charts on the screen. So what this chart is, it is an overlay of 10-year U.S. Treasury yields, and that's going to be the that's going to be the red and black graph here, and it's overlaid with the S&P 500 index, which is going to be the solid black line. So what we can see when I posted this is 10-year Treasury yields 379. We've got the S&P right around 3647. But the key thing to look at is the overall trend. So if we take a look at bond yields, we can see that as bond yields have moved higher through the course of the year, the S&P 500 has pretty much moved just the opposite. So in the middle of June, bond yields touched a near-term high at the time of 348, and then they made a sharp move lower. At the same time that bond yields put in their short-term top, the S&P 500 put in the short-term low. As bond yields pulled lower, the S&P went higher. They met for a little bit in August, and then bond yields reversed to the upside, S&P to the downside. So what the relevance is of this chart to me is I think it's very important that we keep an eye on what bond yields do from here. So 4% overhead is actually a key technical resistance level that goes back to 2009, 2010. So I don't have that on the chart, but 4% is a key level. So if for some reason, if bond yields stay under 4% or start to trend lower, and they're higher right now, but if they stay under 4 or if they start to trend lower, then I would look for some type of a counter trend move in the S&P 500. By the same token, if bond yields start to break out over 4%, then I would expect more weakness in the index. So I always want to stay focused on the chart that I'm trading, but I think it's very important that we stay aware of what's happening in the bond market and with bond yields. Excuse me. So chart number 2, QQQ NASDAQ 100, ETF. So a couple key things on the chart. We can see that NDX right now, QQQ, is trying to hold over the mid-June lows. So it's very weak right now. As I look on the screen, the NASDAQ's down about 3% on TV. So couple key levels to watch here. If for some reason QQQ can hold over 268, which was the June low, and then get a close over 280. If we get those two things, a hold over 268 and then a close over 280, then I think it could set up QQQ for a possible shorter term counter trend rally. If we get a close below 270 on QQQ, that would actually be the lowest close of the year. That would undercut the June closing lows, and I think that could open up the QQQ chart to the downside. So I've got 2 positions in QQQ. I've got some longer dated put options, and we've had some put options along the way, and we've taken some gains, and we booked some more gains last week. So I have a very small long position in QQQ that I started this week right inside this range. But I also have longer dated put options to cover the downside. So the key thing that I'm looking for, if we hold over 270, over 268, and then close over 280, could set the markets up for a shorter term counter trend rally. How long that lasts for, we don't know. But right now, by looking at the charts, looking at the screen, the risk, I think, right now, if we close below 270, is to the downside. So the best way that we've been playing defense on the website is cash. Right now, we're over 80% cash. We're actually over 90% cash. And then I've got some put options. So I do want to have some long exposure if we get that move to the upside, but we're mostly cash right now. And then we've been booking gains and rolling these puts down along the way, so that if for some reason the markets test lower, we can book gains along the way and stay defensive. So now I'm going to move to 3 charts on the long side, because what I found is that in all of the volatility, there are still people that are looking to maybe build longer term positions, maybe put some cash to work, maybe start to scale in on the way down. So what I do is I present the best technical ideas every day. And then obviously everyone does with the information what works best for them. A lot of people have a lot of cash right now and aren't buying anything. I'm not actively buying anything right now, so that makes sense. A lot of people are building smaller positions along the way. So I'll share a couple charts that are higher on my screen. So we're going to start with Netflix. And Netflix obviously is a leader in the media space, but the key thing to look at on the chart is a few things. The first thing is it's holding over a rising 50-day moving average. So this is always one of the first key things that I want to look for in a chart on the long side, is a rising 50-day moving average. So we just took a look at QQQ, which is down here on the chart. We just took a look at the S&P 500, which is down here on the chart, but we can see that Netflix is up quite a bit off the recent lows in the summertime. It's also trending higher. And in the month of September, which has been a very, very difficult month in the stock market, as we know, in the month of September, if we look at where Netflix closed the month or started September and where it is now, it's actually higher on the month. So even in a very, very difficult market for stocks this month, Netflix has been being accumulated. We can see some volumes coming in on the upside, and this stock is showing a lot of good relative strength overall. The key support level that I've got here is 210. So we can see 207, 211, 19, 15, 21. So on any pullbacks, I'd want to see 210 hold on this chart. But for those that are looking at long side ideas, whether it's just building a watch list right now and waiting until the volatility dies down, or that are looking at scaling in smaller, Netflix is very high on our list. Number 2, BJ's Wholesale Club. BJ's Wholesale Club is a defensive stock. We all know, we're familiar with them in the retail space, but same thing, rising 50-day moving average. That's the key thing that I'd like to see. BJ's is actually stronger, so it's over the 200-day moving average. And we can see over the past month, once again, if we take a look at September, where BJ's started, it's drifting a little bit higher, made a new high, pulled back to the 50-day. But this is easier to see a closer term support level. So 72 in the near term is where I'd want to see this chart hold. So if it holds over 72, then I would give the benefit of the doubt to the upside. If for some reason it loses this rising 50-day and it loses 72, then I would move that chart off of my list. So once again, a lot of what happens with most of these stocks could be based on what happens in the markets overall. So, but BJ's, for those that are looking at either building positions or building a watch list, that has been holding up very well. And then Eli Lilly, they're a market cap, they're a mega cap leader in the healthcare space. So Eli Lilly recently made a new high yesterday with some favorable developments over at Biogen. Eli Lilly has a comparable drug to Biogen. But we can see for the most part in 2022, the chart's been trending higher. Now, it's been volatile recently with a lot of charts. 50-day started to turn down, but with this move higher yesterday, it's back over all 4 moving averages. So there is a price gap here, 315 and change. Some people subscribe to the belief that all price gaps get filled. That happens a lot. I haven't seen it happen all the time. So if we take a look at this either right where it is or put it on some type of a pullback watch list, but overall, this is a chart that's been trending higher in 2022. It's over a rising 200-day moving average, which is held for a while now. It's back over all the moving averages, and it's in a more defensive sector. So those are a few charts. Obviously, our positioning right now is much more defensive. We've got a lot more cash than we normally carry. We've got these put options that we've been taking profits and rolling them down to protect the downside, because even in volatile markets, when there's all red on the screen, it's very possible to book gains along the way as well. So that's it for today's video. I appreciate everyone's time, and I hope you enjoyed the video. Thank you.